Welcome to Money Matters TV. My name is Dave Emery. I'm with Planning Capital Management. We have a great show today. I'd like to introduce my co-host, Doug Hepburn of Hepburn Financial Advisors. Hi, Doug. How are you?
Great, thanks. How are you, Dave?
Doing
Good to
real
see you.
well. Good to see you. Wanted to first read a quick disclosure. Um, Doug Hepburn is an investment advisor representative offering securities and investment advisory services through Cetera Advisory LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other entity. All right. Well, welcome. It's good seeing you again.
Yeah, good to see you too.
So,
Good to see you too.
so I thought I start off the show by kind of chatting a little bit on what you see for 2022 as things start to unroll here.
That's
And-
probably what's on everybody's mind right
Mhm.
now. I mean, we had the huge V-shaped recession, if you will, and
Mhm.
recovery, and a lot of great growth last year. But then growth started to slow down in the fourth quarter. So we're seeing growth slow down, I think, principally because of uh, the supply chain constraints, right?
Mhm.
And
Right.
also people's expectation of growth has been dialed back just
Mhm.
because the likelihood of additional stimulus is pretty slim at this point.
Yeah, right. I mean, I think kind of piggyback off of that. Yeah, that along with the COVID is just still hanging there with us. I think there's some unsettledness with that with the
Yeah,
labor market. Um, the Feds are signaling that there is going to be increased interest rates moving forward, and with both of those items and the supply chain, yeah, I just anticipated that 2022 will be slower than 2021.
yeah,
So.
I agree, and that's what I'm hearing from most economists.
Mhm.
Um, just because they're projecting 3 interest rate hikes
Mhm.
for this year. Now, most of them are expected to come, probably in the middle of the year to the
Mhm.
end of the year, second half. So, but it'll be interesting to see how much that's of an effect that has on the economy. I think
Yeah.
they only expect quarter point increases, so it's probably not going to be much to slow down growth. But the Fed needs to respond because
Mhm.
we're seeing some pretty high inflation, and that's
Right.
caused a lot of concerns.
Yeah. The whole topic of is inflation transitory or not? I mean,
Right.
that's on people's minds too. So with that and interest rates rising over over the course of 2022, it makes sense as to why things will may not be as robust in 2022 as they were in 2021.
Right. Well, I think the big question mark on the inflation front is, a lot of people say it's going to be transitory, and although the Fed removed that language from their most recent announcement,
Hmm.
um, with the supply chain bottlenecks that we're seeing,
Hmm.
there's the chance that we're just going to see a flood of products at the very end. All this stuff that's
Hmm.
been held up is
Right.
finally going to hit the markets,
Right.
and it'll be interesting to see whether prices actually go down. I think,
Yeah.
and when that happens,
Hmm.
when are we going to see the flood of goods finally hit the market when things normalize,
Right.
and is that going to drive prices down?
Right.
Um, that's a big question, and particularly for the Fed, because the
Hmm.
last thing they want to do is see prices go down and get into a deflationary spiral. But I doubt that that's going to happen.
Yeah. I think that's a great point. I mean, we hear about all these freighters are off the coast of California, and yeah, when they finally
Right.
it does finally normalize, and
Or
I
get
don't
to
know.
Miami.
Yeah, exactly. I'm not quite sure when that is, but you're right. I mean, what's going to happen? Is people going to inventory those products and then kind of wait to sell them off at higher prices, or are they going to, what's going to happen? I don't know. So it'll be
Yeah.
interesting.
And interest rates are going to play a big part in that, I think,
Hmm.
because Just imagine for a second you're a retailer and or a wholesaler and you've got all these products on your shelf.
Mm-hmm.
If your borrowing cost is really low, you can afford to keep them on the shelf and sell them at a higher price. But
Right.
if you've got loans you have to pay,
Exactly.
or if you just paid cash for it and you're cash flow positive, there's no real need to sell. But if you
Mm-hmm.
got loans you have to pay, you're going to be unloading inventory as quickly as you can,
Right.
as long as margins hold up.
That's right. So let's maybe shift gears a little bit. We talked a little bit briefly about alternative investments before the show. You want to talk a little
Right.
bit about that?
Yeah. Well, it's interesting in this reach for yield that we see a lot of people doing in their portfolios.
Mm-hmm.
You're seeing that treasuries really aren't yielding anything. I mean,
Mm-hmm.
they're more ballast for a
Right.
portfolio. And so, what else do you have to sort of balance out your equity positions? You got corporates, high yields, and which are generally the typical
Mm-hmm.
asset classes that people will
Right.
model in there. But high yields are at really high prices right
Mm-hmm.
now, and so people are looking at alternative investments as a way to sort of get fixed income or even equity returns with fixed income risk.
Right. Right.
And when people think of alternatives, it's a whole asset class of uh, investments that may have less liquidity, so they're longer term investments. For example, real estate is a very
Mm-hmm.
popular alternative investment,
Right.
um, and other ones such as um, bank loans or private lending. In the financial crisis of 2008,
Mm-hmm.
we had a lot of companies started up to do direct lending to private companies. So alternative investments, I think, are going to be important this year in order to balance out people's portfolios and generate some yield.
Yeah.
But it
That
all
makes
depends on what your risk tolerance is, time horizon, and your appetite for liquidity. So
that makes sense. So um, and I'll fold in nicely to the guests we have, which we'll be introducing here shortly. So
yeah,
you got time for a question?
sure.
Okay.
What do you got?
Okay. Question that we have is from Sam Martin. He's in Boston, and the question is, what are some advantages of buying ETFs?
Sam, that's a great question. For many years, people invested in mutual funds, and mutual funds were great vehicles for a long time, but they had a couple of inherent issues with them. One is that they only settled at the end of the day, and
Mm-hmm.
two, when you bought in, you may be buying into unrealized capital gains. So when they sell off those securities, you pay gains on stuff that you really didn't participate in. Exchange traded funds were developed as tax efficient vehicles that can trade throughout the day. So you don't have to wait until 4 o'clock for them to settle. And there's full transparency in what they own. In addition, many of them track indexes. They also have lower costs. So the world is actually very quickly moving to exchange traded funds as a vehicle for a lot of portfolio management.
Good answer. Fantastic answer. So if you're interested in sending a question to Money Matters TV, here's how you do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Fantastic. So we have a wonderful guest here today. Our guest is Dan Delmar. He's from Virtual Angels Network. Welcome, Dan.
Thank you. I'm glad to be here.
Glad to have you here. So can you start off by telling us a little bit on what is angel investing?
Well, angel investing is investing in startups, very young businesses. The investors, called angels, normally invest after the founder of the business, if the founder has money to invest initially, and after any investments by friends and family, if that happens. The angel investment round of financing is typically before investment by institutions, that is, venture capital funds. Angels are investing their own money, while venture capital funds invest and manage other people's money for a fee.
Interesting. So
It sounds like there's probably a lot of risks associated with angel investing. Is that right, Dan?
Yes, individual angel investments are very high risk. They're also illiquid, for you can't cash them in or sell them for a good 5 to 10 years. Historically, 70% of individual angel investments have returned less than the amount of the investment, including returning nothing. They lose all your money.
Wow. So you may just be buying tax losses.
Well, yeah, on the one side. On the other side, 20% return one to 5 times the amount invested, but that's after some years of waiting.
Yeah.
And then 10% return 5 times or more the investment. So it's a big dispersion. The last 10% really provides all of the profit of the whole portfolio. The problem is that you don't know when you invest which will be the highly successful one, or if you even have one in your portfolio of angel investments.
Right.
So what is an appropriate angel investment portfolio? Can you talk a little bit about that?
Well, it's somewhat based on the levels of risk and the dispersion of return. So 80% of angel investment checks are for $25,000. 10% are smaller, 10% are larger. You need a minimum of 10, preferably 20 separate angel investments built up over 3 to 5 years, probably. Now, the SEC requirements for accredited investors, which is what you have to be to invest in angel investments, is either $200,000 a year of income for an individual, or $300,000 a year for a couple, or $1 million net worth investable assets, excluding the equity from your home primary residence. So generally speaking, it's advisable that the total amount in angel investments should not exceed 10% of your whole investment portfolio. You should be prepared to lose individual investments completely. And you should leave some of that for follow-on investments, if you choose to, in the few companies that you invest in that are successful, because they usually do later rounds as they grow. They need more money before an exit. So you should do your due diligence, more likely to succeed financially. At Virtual Angels Network, we leverage the due diligence work of our members to the benefit of all members. And a study by Kaufman Institute showed that exit multiples were 3 times higher when an investor had expertise in the company's industry. So at Virtual Angels Network, we leverage the varied industry experience of our members to the benefit of all members also. And given the high risk of each individual angel investment, there's also great benefit from diversification, including diversification of industries. So an example for my angel investing, my greatest career experience is in enterprise software. Well, my angel investments are in enterprise software. I also have had a very successful investment, almost 9 times return, in a pet food company, which I would say is as different as possible from enterprise software.
Sounds like it.
Yeah, I would say so.
So I have the other half of my angel investments in a wide variety of industries for diversification.
Unless it's a pet computer, right?
Yeah.
Yeah.
Haven't seen that one yet.
Computer pet food. So, it sounds like angel investing is obviously pretty risky. The SEC requires that you be an accredited investor. And a small portion of your portfolio is allocated to it. Why would people do that? I mean, is it really just for the potential high multiple of return on a small number of companies you invest in?
Well, yes, the financial returns are the most important reason. There's a study by Robert Wiltbank of the Angel Resource Association that showed that the average internal rate of return of U.S. angel group investments is 22% per year. That's very attractive, particularly in an environment where government bonds return a couple of percent. Angel investing also tends to be a good diversification from stock market investing and economic risk. Each individual angel investment is high risk, but the risks are different than the general stock market risk. Angel investments perform primarily based on the performance of the team, the product or service, and the individual businesses, as opposed to stock market investments, where a big risk is the overall economy, recession, or high inflation.
And just the standard systematic risks that come with stock market investing, technical risks like supply and demand of buyers and sellers.
Yeah, and
it's an illiquid product.
It is. There are a couple of non-financial issues or opportunities, benefits as well of angel investing. Involvement with and support of the entrepreneurial community, which is the growth engine of our economy, and being exposed to leading edge technology and businesses. That's very interesting, exciting, and certainly one of the main motivators for me.
So, can you talk a little bit about why join an angel investment group? I guess there's a number of choices. Why, can you talk a little bit about that?
Yeah, well, the first reason is teamwork. With all my career experience, when I started angel investing, I did not want to make these decisions, investments on my own. Mm-hmm. Now, even after more than 10 years of angel investing experience, I still want other people on my team with their experience, questions, and judgment. So we do due diligence together. It saves a lot of time to do it together, to do all aspects of the whole process together.
Sure.
And at Virtual Angels Network, at the end, on the other hand, after all this teamwork, we still leave the choice of whether to invest or not in a particular company to the individual. And I certainly like that responsibility and authority to make my own decisions.
So how big of a group is you typically have of an angel investment group? Is it just a couple of people, or is it how big are we talking?
The groups around the country traditionally have ranged from 20 people to a couple of hundred, but the most common is like 50 to 75.
So I had a follow-on question to something you mentioned earlier, and you said that, and I found this interesting. You said everybody does their due diligence, but they each individually invest. So it's not as though somebody is putting money into, say, a fund. Where the funds are where the money is invested based on the manager's decision.
It's the opposite.
In the network. Okay.
Yeah.
Interesting.
Yeah, you get the benefit of knowledgeable people among the members, but you get the authority and responsibility of making your own decisions on individual investments.
Interesting.
Yeah, a venture capital fund is a very reasonable alternative for some people who don't want that responsibility, you might say.
Right. But don't venture capital funds typically come in after the angel rounds?
Yes, they tend to be a little later, making larger investments in
Right.
more mature companies.
Okay.
Interesting. Fantastic.
Yeah. What made you no? So what made you start Virtual Angels Network?
Well, my career, many decades, was primarily in consulting at Bain and Company for 5 years, Accenture for 3 years, but mostly more than 20 years, 3 different times, my own consulting practice. And I also had a couple of corporate roles, the most recent being 6 years as an executive in IBM's corporate strategy department. So when I started and I'd done a lot of investing in public stocks over the decades, some of it very successful. And 10 years ago, 11 years ago, I was a founding member of the Harvard Business School Alumni Angels of New York. And for the last 7 years, I was on the board of HBS Angels of New York as their chief mentor. And when the pandemic hit, everything became virtual. I realized there was an opportunity to overcome one of the limitations of HBS Angels, which was that they only allowed members who were alumni of Harvard. And so I started Virtual Angels Network, a completely virtual national group of experienced MBA and other advanced degree holder angel investors. I opened it to a much wider range of people. And what we do is bring the best deals from all over the country to our members all over the country. And our website is virtualangels.net.
Fascinating.
So what are the startups that apply and pitch to Virtual Angel Networks like?
Well, the first thing is that they're venture scale. They're very high growth potential companies. They're typically technology. Well, they're pretty much all technology enabled, and a smaller number of them are actually advancing technology themselves. In terms of industry, there's a wide range. The largest industry, the most common, is companies from healthcare and life sciences, including medical devices and digital health. But there's also internet businesses, software, consumer products and e-commerce, agricultural, chemicals, alternative energy, financial technology, known as fintech, all kinds of industries. Now, in terms of stage, as we touched on so forth with Doug, everything I'm going to say about stage is different for healthcare companies that require some version of FDA approval about other industries. There's companies in the idea stage. We're really not interested in those.
Right.
Pre-seed, first outside money, $100,000 to $500,000 that they're raising. We have some there, and they're typically at like a $2 to $4 million valuation. The most common is seed stage companies. They probably have an MVP, a minimum viable product, maybe some customers, more to prove product market fit than for financial impact. And they're raising $500,000 to $4 million. And most of the companies we invite to pitch are at this, and they're valued at $3 to $15 million. And then there's some more mature companies, Series A round financing. They're typically $1 million of revenue annually, growing rapidly, raising $2 to $15 million, pre-money valuation of $10 to $15 million. Used to be that Series A rounds were in the range of $2 to $5 million, but over the last few years, the amounts raised and valuations have shot way up.
So the ones that pitch you, I mean, I assume that not everyone that pitches you ends up being part of the people that you invest in. Is that right?
Oh yeah, there's the process is that we source deals from all over North America. Our members attend many virtual pitch events from other angel groups and pitch competitions, and encourage the most exciting young companies to apply to Virtual Angels Network. Now, we also get a good number of applications directly, but frankly, none of them have been up to the standards of our recommended applications.
So the rejection rate's probably pretty high.
Yeah, and that's just the first stage. So we generate high quality. I beg your pardon?
That's
Yeah.
a good thing, because it weeds out the products and companies that probably aren't going to be profitable.
Yeah, we generate high quality deal flow. And then we use a communications platform called gus.com, which is used by hundreds of angel groups worldwide. We get one or two of our members or people in our networks who have experience in the industry of the applying company to screen the application materials, rate them, and then we invite the four to our pitch event. They have 7 minutes to pitch, 7 minutes for questions, and then afterwards we have a discussion without them there, so we can be honest.
That's great.
Then we do due diligence, and then people get to make their decisions as to whether to invest or not.
Well, that's great. Well, so we have a couple more minutes left. This is some really great information. So maybe you could comment on in the last couple of minutes, what kind of people join Virtual Angels Network?
Yeah, well, we're quite exclusive. We require an MBA or other advanced degree. They have to have work experience, at least a decade, and some of our members have a number of decades of experience. It can be experience in any industry, since we look at many different industries, and they have to be an accredited investor, which they self-certify. Beyond that, we have a wide variety of members. Some have made dozens of angel investments. Others have made just one or none, and they appreciate the opportunity to learn. Some have never belonged to an angel group. Others have belonged to a local angel group and get the benefit. And some belong to several angel groups already and want to broaden their deal flow further, get the benefits of drawing on the experience of our quality members. Some have time to contribute to sourcing, screening, and due diligence, or taking a leadership role in virtual.
But that's not required, is it?
It's not required, exactly. Others have almost no time, and they want to benefit from the wisdom and work of other members. So, as I mentioned, our website is virtualangels.net. We have a virtual pitch event on Thursday, January 20th. If any viewer would like an exclusive invitation to that pitch event or the next one, email me now at dan@virtualangels.net and provide you a LinkedIn profile link.
That sounds great.
If you've never attended an angel group pitch event, I think you would find it fascinating. And if you have attended a pitch event, I guarantee that you will find the quality of the company's pitching, the members attending, and the conversation to be exceptional.
Well, that's great, Dan. I really appreciate all the insight. Very interesting topic. So thank you for joining our show.
My pleasure.
So I just want to announce our guest for next week. It's Jorg Algrim, and he's the CEO for the Center of Breakthrough Medicines. So make sure to tune in for that. I just want to say thank you for joining us on Money Matter, and just remember, this is where your money matters.